Every investor on the planet is looking for an edge, right? Some kind of advantage. Well, what if I told you the key to smarter investing wasn't some brand new, super complex algorithm, but a statistical tool that's almost 100 years old? Today, we're going to dive into a really fascinating strategy that uses a concept called financial turbulence to build a portfolio that's way more dynamic and responsive to what's actually happening in the market.
It really all starts with this fundamental question that every single one of us has to answer. Do you go passive, the whole set it and forget it approach? Or do you go active, trying to be the genius who outsmarts the market? Well, this research makes a pretty bold claim that maybe, just maybe, that's a false choice to begin with.
And that's because, let's be honest, both paths have some serious flaws. On one side, you have the passive robot. It's incredibly disciplined, sure, but that same rigid discipline can literally force you to buy more stocks right as the market is about to fall off a cliff, kind of like what happened to a lot of people in mid-2008. Then on the other side, you've got the active genius, who more often than not is just chasing whatever's hot this week and ends up, as the paper puts it, being fooled by randomness. So yeah, neither one is the perfect answer.
So why are both of these classic approaches kind of struggling right now? Well, it's because the market itself, it's just not the same animal it used to be. The ground has shifted beneath our feet, and we're all trying to figure out this new normal for investing.
Think about that old core idea of diversification, when stocks go down, your bonds go up. Well, that's becoming a lot less reliable. Over the last couple of decades, everything has started moving together, almost in lockstep. It's all being pushed around by this powerful, invisible tide that this research calls a global risk factor. When fear takes over, pretty much everything drops. When greed is in the driver's seat, everything soars.
And look, this isn't just a gut feeling. The data here is absolutely crystal clear. If you use a metric that basically gives the market a herd behavior score, you can see this dramatic shift. Before the year 2000, markets were in this super-linked herd state, only about 13% of the time. Since 2000, that number has nearly tripled to 38%. The game has fundamentally changed.
Okay, so if the market's behavior has totally changed, then we need a new way to read its mood, right? We need a better indicator for when things are about to get really rocky. And the search for that signal leads us to a surprisingly old and frankly pretty unusual place.
And here it is, the Mahalanobis Distance. Now, I know, that sounds incredibly complex, but stick with me because the core idea is actually pretty simple. It's just a way of measuring how weird something is compared to the norm. And the really cool part is that it's smart enough to understand how different things are related to each other, which, as you can guess, is absolutely perfect for the tangled web of modern finance. But here's the kicker. This is the best part. This super sophisticated financial tool wasn't invented by some whiz kid on Wall Street. No, it was developed back in the 1920s by an Indian statistician to tell human skulls apart. I mean, from anthropology to asset allocation, you can't make this stuff up.
So how in the world do you get from skulls to stock markets? Well, it's a surprisingly simple 3-step recipe. First, instead of measuring skull dimensions, you measure a whole bunch of different assets. Second, you figure out how they've historically moved together, their relationships. And then, step 3, use all that info to calculate one single weirdness score for the market on any given day.
And that weirdness score is our signal. It's what allows us to put a hard number on something investors have always just felt in their gut: financial turbulence. So this is the really crucial point. We can now define financial turbulence with actual precision. We're talking about any time the market's weirdness score, that Mahalanobis Distance, spikes up into the top 10% of its historical range. This isn't a guess or a feeling anymore. It's a data-driven alarm bell telling us the market is acting weird and risk is way up. And here is why that alarm bell is so incredibly powerful. Look at this. In calm, non-turbulent markets, stocks do great, just like you'd hope. But the moment that turbulent signal flashes red, everything flips on its head. U.S. equities go from a plus 12% return to a nearly 10% loss. And at the exact same time, check out gold. It goes from being just an okay performer to an absolute monster, rocketing up by 37% annualized. This signal cleanly splits the market into two totally different universes. Okay, so that's some seriously powerful evidence. But a cool signal on a chart is one thing. Does it actually work in the real world? Can you build a better portfolio with it? Well, the researchers decided to put it to the ultimate test, a head-to-head showdown. So they set up this bake-off running from 2011 to 2023.
In one corner, you've got the old champion, a standard 60-40 buy and hold portfolio. In the other corner, you've got the new challenger, a dynamic asset allocation strategy. It starts at 60-40, but, and this is the key, it uses that turbulent signal to shift its holdings, getting safer when things are turbulent and more aggressive when they're calm. So, the result? The dynamic strategy, the one guided by our skull measuring turbulence signal, delivered an extra 1.61% every single year. Now, that might not sound like a giant number, but let me tell you, in the world of professional money management, consistently generating over 1.5% of alpha, that is a massive, massive win. That's the kind of edge careers are built on.
But hold on, it gets even better. It wasn't just about getting higher returns. Take a look at that second row. The dynamic strategy was actually less volatile. It was a smoother ride. And then check out the third row, the max drawdown. When the market hit its absolute worst point, this strategy lost less money. So you're getting higher returns with lower risk. I mean, in investing, that is the holy grail. Now, any savvy investor watching this is probably asking a really important question right about now. Okay, this is cool, but is this just a new name for an old idea? I mean, is this whole turbulence thing just another way of measuring momentum? Or maybe it's just a value signal in disguise, or any of those other well-known factors that we already know drive returns? It's a completely fair question. And the data gives us a really clear answer. Nope. The researchers tested the turbulence signal against all the usual suspects, momentum, value, size, all those famous factors, and they found pretty much zero correlation. This isn't just a remix of an old tune. The evidence suggests that financial turbulence could be a genuinely new, independent factor for understanding the markets. So, what's the bottom line here? What should you take away from all this? Well, the key points are pretty straightforward. First, this turbulence signal is fantastic for downside protection. Second, a dynamic strategy that uses it can seriously outperform a simple passive one. And hey, even if you're not building automated strategies, it can help any investor make smarter calls about when to rebalance or rotate assets. It's just a really powerful new tool for your toolbox. And all of this leaves us with one final, kind of mind-bending question. If a statistical tool designed to look at skulls almost a century ago can give us a real edge in today's crazy complex markets, it really makes you wonder, doesn't it? What other incredible signals are out there, just hiding in plain sight, waiting for someone to connect the dots?